Hey everyone, I have an exciting show for you today. Actually, just so we get it out of the way, linked in the description below is the one-on-one interview with Greg and Grant Cardone. That is the interview that I've watched several times now, and I have a bunch of questions for Greg because those two gentlemen operate at a level that I have never been. I have lots of questions for myself and likely for you. So let's welcome Greg to the show. How you doing, buddy?
Hey, good, Michael. How are you?
Hey, man, I really appreciate you giving me some time because usually we talk on Mondays. I love that interview you did with Grant. I got to tell you, I understood about half of
Yeah.
it. Kind of half was in my wheelhouse. As you and I talk every week, I'm more residential, you're big time. Watching you two go through that was interesting. So if you don't mind, I got just 2 or 3 pages of notes. I just want to pepper you with questions and go one by one. Is that cool?
Yeah, let's do it. There's been a lot of questions, a lot of great feedback. I think a lot of people enjoyed it. I enjoyed the time and the conversation. So yeah, man, let's do it.
Yeah, I enjoyed it. I've never seen Grant be so relaxed. And I don't mean this negatively, but he seemed like a human being for the first time versus some kind of, you know, character out in entertainment land.
Yeah,
So
he's a great guy, very personable. And,
yeah,
there's a whole nother side to Grant that people don't know and never see. And,
yeah, I never seen it before. Yeah,
I think that came out yesterday.
that was cool. All right. So these are roughly in order of the video because that's just how I did it this time. So right out of the gate, he talked about himself doing deals differently.
Right.
He talked about buying them in his name. And then he talked about this word recap. I think I get it, but I thought we should break down a number, a sample, so people can really appreciate why what he does is different than others and really break that down, that world of recap. Do you want to give an example or do you want me to set one up?
Yeah, let's do it. So do you have your little whiteboard? I don't have a whiteboard.
We just walk it.
I can't draw on the dogs. So everybody loves the dogs, man. He was like, dude, that's a great picture.
That's awesome.
Yeah. So it makes an interesting background. So recap is recapitalizing a property project, but you can do it with anything. It can be a business, any kind of investment. So you're recapitalizing, meaning you're removing one source of capital and replacing it with another. So what he does is he'll go buy a deal. Let's say it's a $100 million deal. Okay. He'll put that $30-40 million down himself out of his own funds, and then he will replace that, recapitalize that investment with investor money. So he's raising in a fund, whereas most investors and syndicators raise per deal. When you go out and you use a private lender, you're putting one lender in one deal.
Yep.
And so imagine if you bought the property first and then you got that individual to come replace your cash in the deal for exchange, of you letting him in the deal and giving those returns. You can do it on one deal. So what you could do is, instead of waiting for the investor, you could use your own funds, go buy deals, and then back your investors into it, recapitalize that deal, pull your investment back out. So that gives you the momentum. That's why Grant can buy so many deals so fast.
That's interesting. That's essentially what I do, minus lots and lots of zeros. So let me repeat that back to make sure I understand it. So again, we'll use your example. He goes out and buys a $100 million apartment building. He gets Fannie or Freddie debt for $70 million. Again, these are just examples. He wires $30 million from Grant Cardone family fund, blah, blah, blah. Deal's done, right? He owns that apartment building. He then comes back to Cardone Capital and says, okay, Cardone Capital, you need to replace up to, because he may not take all of it. He may want to leave some money in the deal, right? Because he wants the dividend too, or distribution. But let's just say he wants $30 million back. So Cardone, so how does that work? So where's the first go? Because he's replacing what I'll call equity, for lack of a better term.
Yeah, it's equity, just, down payment, equity, same thing. Okay. So think of this as a private money burr. Same thing. So instead of refinancing with a bank and pulling your equity out, you're just using the private investors.
You're switching equity. Okay.
Switching equity. So what he does, and if you go on Cardone Capital, you can sign up and you can see all this. So he has different funds.
Yes.
So as opposed to raising for that building, and it's not Cardone Capital that does it. Okay. It's a fund. So it's Cardone, whatever, fund 5 or 6 or 7 that he's raised money. So when you see him, out there saying, hey, invest with us at Cardone Capital, you can go there, and then there's different funds that are open for you to invest in.
Okay.
So, and this isn't a pitch for Cardone Capital.
No.
This is just how he does it. So you can go in there, you can choose, and he might even still have some standalone properties that he's raising for aside from the funds. I don't know. But this fund is what is actually investing in that project. So it's actually owned by the fund at that point.
Got it. So one last question, because again, I'm trying to tie it with what I do. Again, minus lots of zeros. The fund actually has the capital, right? Let's just say I pick Fund 5 to use your number. I wire
he's already
$100,000.
raised that money.
Yeah. So the money's sitting there. And while it's sitting there, is it like dry powder where it's it's just sitting there, right? And then he replaces it when he buys that $100 million building. Okay.
Exactly. And there's a time limit on that. So like he might call all the capital, from the investors over a 3-6, month period.
Makes sense.
That it sits there. And then once it's deployed within that time frame, then it starts earning.
Got it. And then if it's not deployed, I guess, never mind. There's all kinds of rules in the fund, follow the rules, but I got it.
Yeah. And there are. So this comes from the world of equity capital. So it's more traditionally used in buying companies. So you go out, you raise the money, the investors, you call the funds. So you bring those monies into an escrow account, and then that money's in there to get deployed into purchasing assets or companies. And you have a time frame. So if you don't do the investments over a certain period of time, then all the monies are returned to the investors, and then they just don't,
Gotcha.
It's just deals off.
So one of the questions that didn't get drilled down in the interview, and if it did, I didn't understand it, was he talked about, this is what I used to do, like pre-COVID, he said, right? Which is what we just went through, which makes me think he may do something extra. He did use the word blind, I think, in the interview. Does that, I don't understand. I don't understand what will be different after. And if you don't know, totally fine. But I was curious what would change from before to after. And if you don't know, it's totally okay.
So a blind fund is where there's no target. So you're raising the money, then you go out and buy. Versus what he's doing now, he's got targets. The assets have already been purchased. He's recapitalizing those with investor cash. So a blind fund, you're just raising a fund, then you go out and you start buying stuff. So he's not buying it himself first. Now he's using the fund.
Okay, so he skips.
Yeah.
The recap doesn't happen.
Exactly.
Got it. Okay.
Yeah.
All right.
So it's a blind pool, blind fund.
Sure.
And I get that all the time. People are like, man, I want to raise a blind fund just like Grant does. And I'm like, you don't, and I've made videos on that. You don't want to raise a fund. You need to be experienced, sophisticated. It's still a Regulation A filing, which requires a lot of disclosure, a lot of financial auditing, and it's expensive. It's probably $100,000 or more to set that fund up.
Yeah. No,
and then once you pull that money in, then the clock is ticking and you got to pay those investors in a blind fund. So then you got to go use it.
Yeah.
So you don't want to do that until you've got a machine and you've got deal flow and you've got a team to execute.
Got it. So okay, perfect.
And he's saying that because there may be some opportunities and some distressed opportunities. So you want to have dry powder. Yeah. So, Grant's Grant's liquid. Liquid generally means north of 100 million. Now, I haven't seen his bank accounts, but just by his asset qualifications, he's what you call liquid. And, but even still, there's only so far you can go with that. So he wants to raise a blind pool, a blind fund, so that if these issues, when these deals come around, he can take advantage of them and go ahead and not have to raise and not have to worry about it. Yeah,
because clearly he's, again, as you guys talked about several times in the episode, he is a preferred buyer that was thrown around by Fannie and Freddie. Yeah. He's already having, I forget where it was, Houston or San Antonio or Phoenix, somebody calling him to buy 1,700 sight unseen. So he's already getting those phone calls. So that makes sense why he would skip the recap. He just wants the blind fund because he sees more opportunities coming faster. That's kind of, I think, what you're saying. Okay.
Yeah. And it's a different structure. So there might be more opportunities depending on what happens. So that's why that works. And again, you could do the same thing with residential.
I like it. We're going to talk
one-on-one. You can raise a blind fund of $10 million to go out and buy a bunch of houses.
Yeah. See, that's why I like talking to my experts. They help me grow. Okay. Next up, this is something that Grant's talked about for a long time. Obviously I'm in the one rental at a time kind of single family home area, but I just thought we would talk about it because I want your opinion. He talks about the most important thing is the number of units is the key to protection. Right. He talked about, hey, I had one house, 2 girls in it. They left. I had to carry everything. When you see him walk through that, he's basically saying hundreds of units in apartments are the more, the better way to protect you. I guess my question for you is, do you see a difference between a unit apartment versus say 50 homes? Right. Cause I agree scale is important, but I don't like leaning towards apartments are the only answer, but maybe I'm wrong.
No, they're not the only answer. Okay. But it is the only way to scale it. So the problem with, time, right? I can go buy 100 units under one roof right now. It's going to take you years to buy 100 houses. And then they're all over the place. You got all these different tax bills. You got all these different insurance bills. You got all these different rent, you know what I mean?
Yeah.
So it's very fragmented, and you don't get the economies of scale and efficiencies. And here's the thing I'll say. The interesting thing about that is I know a lot of people that have bought hundreds of houses over a 20, 30-year period, because that's what it takes.
Yeah.
And they all want out. They don't want to keep. At the end of that, they're all done. They're like, done. I don't want this. I don't want to do it. I haven't met anybody that's accumulated 100, 100-unit plus apartment buildings that says, I can't stand this. I want out. I met one.
Got it.
It's only because cap rates have grown, compressed so much, and values have grown for people where they're like, you know what, I was never going to sell a thing, but man, I'd be crazy not to.
Yeah. Okay. That makes sense. Yeah. And you're right. It's the time factor. And if Grant, I think Grant would do himself a favor if he's just highlighted that like in a sub bullet. He may have, and I may have just missed it, but you're right. When you just look at the numbers, right? 50 houses versus 100-unit apartments, I don't see the difference. But when you say you can sign on the dotted line once for an apartment, but 50 times now it's clear. And
yeah, it's just scale, efficiency, speed, to get to a different destination. And that's what he does. That's his focus. That's his model. And he believes for people who want to be where he is, that's how you get there. Mm-hmm. Now, anybody else, and he said it yesterday, that may not be right for them, right? Mm-hmm. And it may not be right for me or you or anybody else. So there's absolutely nothing wrong with getting, 50 to 100 houses. It just takes time. It's a very inefficient model. Now, there are some Blackstones and, BlackRock and some REITs that have done that back in 2009 when all these foreclosures, they were buying them from the banks. So these were distressed.
They were buying pools of loans. They were buying pools of loans, and the houses just happened to be in them. That's what happened.
Yeah. And even Warren Buffett came out and said, look, I'd buy every house I could if I could find a way to scale it. It's just even for a guy like him, who could spend as much money as he needed to on systems, it's a difficult thing to scale. So that's all it is.
Cool.
Absolutely nothing wrong with residential. Nothing wrong with it. Yeah. It's a great way to go for a lot of people.
Yeah, I got hung up on the numbers, and I should have thought about the time. Mm-hmm. So that's a perfect caveat. So next thing you guys went into, he started talking about numbers. Basically, rent collection was good. But I want to make sure I understand it, because I think he talked about two numbers, and he skipped actually the most important number. And again, this could just be my understanding. So he talked about occupancy. And again, I wrote these down. They could be wrong. He was 94% occupied, right? Mm-hmm. And then I think he said 93% collected, right? Those are interesting numbers, but it's actually the multiplication of those that's true economic occupancy. Is that correct?
Yeah. So I don't know exactly what he was saying. I'd have to go back and look at it. But if he did say that, if he said I'm occupied, my occupancy is 94%, my collections are 93%, then that's an economic occupancy. So that's a big thing for people.
So that's 87.4% if I did the math correctly. Does that feel about right?
If
those are the numbers.
Yeah, that would be economic occupancy. And that's a big thing to watch out for when you're buying a property. Somebody might say, hey, I'm 100% occupied. My question is, well, how many of them are paying rent? So that's why you look at what's called a T12 or trailing 12 months of income and expenses. But more importantly, you want a T3, which is the previous 3 months. That gives you economic occupancy. Mm-hmm. But in these days, you want T1, because we want to know, hey, April looked good. What's May going to look like? Because I'm not so sure May is going to look like April, but we'll see. Yeah,
economic occupancy is the thing. And again, I learned this firsthand in the crash because I could tell you I had lots of heartbeats. I actually just called them heartbeats and checks. I had lots of heartbeats and not a lot of checks. Exactly. So I felt that pretty cool. Okay. Then you guys went on to a talk about basically, again, Grant being different than most syndicators because most syndicators have partners, right? The example was 10 partners. I didn't really get the example. He tried to go to 10 partners in a plane. I think that kind of took a left turn and didn't make sense. But I think what you guys were talking about is if you have one decision maker, you don't have to get consensus, right? If you have 10 or 5 or some other number, you'll have, the more people you have, the more complexity it is making decisions. Is that kind of what the point of that was?
That's one, that's what he was saying. So
Right.
what I was pointing out was Grant's done this by himself.
Right.
Just like you've done what you do on your own,
Yep.
what I've done, what I did on my own. What happens in the multifamily, and again, he started with nothing, built all this up. So that's what I like about Grant. We don't agree on everything.
Yeah.
We don't have the same, philosophies about everything. But what I do admire is he started from nothing with nothing and built all this up. Right. So you have to admire that no matter who you are. Right. And it's him signing on the line, on the dotted line for everything he does, just like you do. So what I was talking about was in the world of syndication, what you get is you get a lot of people that raise capital, and they might get like 5,000 from you, Michael. They might get 10,000 from me. They might get 20,000 from somebody down the street and whatever to get to 100 grand. Then they go bring that to a deal, and they call that they own that property, or that they have those assets under control.
Yeah.
So that deal that they brought that capital, they're a capital raiser. And so the deal they brought the capital they brought that deal to, there might be a deal sponsor. Then he's got another partner who's an underwriter. Then they got another partner who's a capital raiser. Then they got another partner that's, this, and they got another partner that's that. So you might have 5 or 6 people trying to syndicate a 200-unit apartment deal. You know what I mean? So it's like you're slicing all these pieces up, and then they have all these LP investors that are coming from all over. So a lot of what you see out there with people is they're posting, I own, 1,000 units in 10 states. They may have only, invested not even none of their money, but they might have brought, 10 grand from somebody in this deal, 5 grand from somebody in that deal, or they might have $5,000 invested in 10 different properties all across the country and call it theirs. And it's, deals that they control. So that's what I mean versus a guy like Grant. It's all Grant. It's all him. A guy like you, it's all you. A guy like me, it's all me. So that's the difference that I was getting at. And then he brought it to another level and saying, you get that many people involved in a partnership, man, it's hard to get things done.
Yeah. And I want to second the fact that, hearing Grant's story again, I've heard it. He actually doesn't tell that story a lot anymore, but how he started with that one house and then 32 units and then 42 and then 98 or whatever it was. That was interesting. And where I'm going to next is actually that story exactly. He talks about buying the house, was great while the 2 girls were there. They left. It was a problem. He sold it, made a little bit of money. But then he talks about taking 3 years off to learn the market. Or I think he said, I call it learn the market. I'm sorry, that's my vocabulary. He talked about learning real estate. Any idea really what that means? I mean, obviously he was busy doing his 2 other businesses, which he had, which spun off the cash. But what does that really mean that he took 3 years off to learn real estate, in your opinion?
He got stuck at analysis paralysis like everybody else.
Okay.
He started learning.
Just kept on
studying. He started learning and studying multifamily, looking at deals, walking deals, maybe making some offers. Who knows exactly what he was doing. We didn't dig into that 3-year journey, but that's what he meant. He started learning about multifamily, studying it, looking at properties, talking to bankers, talking to other people's deals, like that. So
I've always figured that, because I shouldn't say it doesn't, but it probably shouldn't take 3 years to learn real estate investing, my opinion. But analysis paralysis makes sense. The other thing,
he's just saying, I guess, a big takeaway there is, look, man, I spent 3 years and he didn't do anything,
True.
And who knows where he was in the market cycle and what was going on really during that time. But I mean, it's like anything else, you're comfortable doing one thing and you got burned on this house and you're like,
ouch,
do I really want to do this? So part of it was probably learning. Part of it was probably fear, even for Grant back then. Like he said, he used to do 300-person events. There was a time when he was probably very nervous stepping on that stage.
Probably.
And you know what I mean? So it's the evolution of things.
Yeah. And again, his first deal, I think I got the numbers right, 1.9 million. He put 350K up. Again, his cash. Everything was him. The other thing he said that I think it just warrants discussion is, as a real estate investor, he doesn't keep a lot of cash. Now, a lot of cash is obviously scalable based on lifestyle and all of that. But really, that's just the point that, hey, cash is, to use Ray Dalio's, trash, right? You've got to get it invested so there's returns and all of that. Is that do you think what he meant?
Yeah, yeah. What he's saying is, whenever I had excess cash, I would deploy it into other assets that would pay me versus like just constantly pumping it back into the business. And, we kind of struck a little thing in there. He's like, you know what? Nobody's ever asked me that before. He said, if I would have taken my cash and put it back into the business versus investing in real estate, it'd be a very different story.
Yeah.
Because depending on your business, there's only so much putting your cash into a business will do for you at a point,
Yeah.
versus taking that cash flow and putting it into other avenues.
Yeah. And I think this is what people really need to hear about today, right? Having a side hustle, having something that's your day job that spins off cash that you can focus on during the day and then invest in real estate, as he called it, the third business. It's very, real estate investing is very rarely somebody's primary business, right?
Right.
Primary action. It's something else, 8 to 5, that spins off cash, and then real estate, again, he called it his third business, and that's actually the next thing we're going to talk about. So that makes a lot of sense. The one thing I do want to talk about, and we actually joked about this yesterday in our call, or at least Monday call, was he wishes he refied versus sold those first 3 apartment buildings. Yeah. And, I thought we should just talk about it. Cause obviously do you know if he sold or 1031 exchanged? Do you know, or you don't, you may not know.
Yeah. I don't know. I don't know if he did an exchange.
Yeah. Cause if he sells, he pays taxes. In exchange, doesn't pay taxes, but has time frames, all of that. But basically let's just net it out. He could have refied them and pulled out a portion of their cash, non-taxable, and kept going. Is that kind of what he wishes he would have done?
Yeah. Yeah. That's what he's looking back on it going, man, I should have done that and just held on to those things because they're probably worth, twice what he sold them for. And that's why I was like, they're still there, aren't they?
Yeah, exactly. That's what you said. Needle.
You drive by, right? You drive by and you're like,
yeah,
I never should have sold that.
Well, yeah,
like that Ford stock that I bought at $1.90 and sold at $6, right? That should have won too.
Been there. Yeah.
Yeah. Well, it's $4 now. So
there you go. Well, still, yeah, I'll take a 1 to 4 any day of the week. But still, in his fairness, again, what little I know about those initial apartments, they're probably worth 5 or 6x what he paid for them.
Yeah, it was California. It could be, but he still knows the guy that owns them. They're still occupied. They're still doing well, which was the other point of the story. If you drive around, look at real estate, especially multifamily, that's occupied in good locations and doing well. I mean, it's just it always is. It's just been there and it's going to continue to be there.
Yeah. So this is where the story, I didn't quite put it together, and it's probably because I didn't understand it. So he sold those 3 apartments off in Southern California, and he's, at least what I heard him say, is he moved it into, a Tucson, Arizona portfolio of 2,200 units.
Yeah, I don't remember exactly, but yeah, something like that, I guess.
But so basically, he got all this cash from the first 3, and then he just bought one big portfolio, kind of like you two were talking at the end about Blackstone, but that kind of felt like the next step. He just bought, hey, I'm going to buy all your stuff, Mr. Seller.
Right, and it could have it could have been whoever that was exiting the business at that point. Yeah.
Okay, and then he sold those and bought. Okay, got it. I want to go to the next one. You guys spent a lot of time on this, basically talking about a $50 million deal being easier than a $5 million deal.
Right.
Basically bigger is easier. You guys gave some good examples, but I think that warrants another discussion because that's not easy for most of us to understand.
Yeah. So number one, when you're dealing at that level, you're qualified. Okay. Mm-hmm. So you're like him. He's a preferred borrower, meaning he's already in the system. He's a much easier fund than somebody coming in that's new. Mm-hmm. He gets preferred interest rates, probably a point or two lower than, a point, or so lower than most other people are going to get. So, he's buying, back before COVID, I mean, he was getting deals at 3.25, on 10-year money. So he was getting some pretty good interest rates on some of his deals, which allows you to buy at a lower cap rate because you have that yield spread in there. So when you're doing a deal that's that large, you have a lot of things on your side. Number one, the lenders. Okay, they have money. Freddie and Fannie have $400 or $500 million that they got to push out the door. So they need good qualified operators to be able to place that money with. Okay, they don't make any money, just like a bank down the street, whatever your local bank is, unless they're putting money on the street, they're not making any money. So they need to deploy capital into good assets with good operators that have a balance sheet, a net worth that can qualify for the loan. So it gets much easier to get done once you've reached that level that you can qualify, because you already check all the boxes. Now it's just a function of, does the deal work? And they're going to underwrite it themselves. So you don't even really have to underwrite it. You do, when you want to. Literally, you could take this deal, hand it to Freddie and Fannie, they'll underwrite it for you and say, yeah, we'll do it or not. I mean, it really gets that simple at that level. Yeah. And everybody's pushing for that deal to close because everybody's making big money. The banks, the brokers, the management companies, everybody's on your side and on your team to make that deal happen. And it's the same paperwork. It's the same, contract. You're going to use the same contract on that $50 million deal you're going to use on a $5 million deal. Same contract. You're going to use the same SEC paperwork, operating agreement, private placement memorandum, and subscription agreement. It's going to be the same thing, and it's going to cost the same amount. It's going to cost you 15 grand for that, just like it is for a $5 million deal. The appraisal might be a little bit more because it's a bigger property, surveys, that kind of thing, inspections, that kind of stuff. But in general, it's just a much quicker, easier process once you've done deals at that level and you're qualified.
Yeah. The other thing I wanted to ask, and again, this may be a question you just don't know. If so, totally cool. But when you say,
I will tell you, the rates are better. Even in the CMBS market, life insurance companies and all that, they will tell you the bigger deals are preferred. It's harder to get a $5 or $10 million deal financed in the credit markets, capital markets, than it is at a $50 million level. That money wants bigger deals because it's easier to place.
Just easier, less transactions to place money. Makes total sense.
Exactly. Just like the one house versus 100 units.
There you go. So this question, again, you may not know the answer to, and it's totally cool, but I want to ask anyway. So when you talk about being a preferred lender or preferred borrower for Fannie and Freddie, I'm always wondering, how big a list do you think that is in the US? Is it 100 people, 1,000 people, 10,000 people? I mean, I just don't know the scale. I'm sure it's low, and I'm sure it's not a lot, but is it 1,000?
Yeah, I mean, it's got to be 1,000 or more. Okay. So what that is, it's you've done several deals, you have experience, you've had several exits, and you've got the balance sheet requirements at a certain level. So again, that you're in the system. Yep. So they don't have to, So I mean, Joe Fairless, that's a big name in the multifamily world. He's a preferred borrower. So so there's a lot of different people out there, and that's the other thing. So Grant right now is close to 8,000 units. That's a lot. 0.7 billion. But when you look at multifamily, and I said that, so some of the largest owners in the country are at 180,000 units. Wow. I mean, the bottom of that list of 100, I think, is 20,000. So he still is 3 times away from getting on the top 100 when you look at, property owners. And they do it by number of units. They don't do it by, value of the assets when they rank those. So yeah, there's a lot of people in the game out there at that level, at Grant's level. And he's done very well. I'm not diminishing anything. I'm just saying, a lot of people think, that's huge. And he knows it. He's like, man, I need to get to this next level. He's just arriving, right? It's kind of like martial arts. A lot of people think the black belt is the goal. Really what happens is once you get to black belt, that's when you begin. That's when you become ready to learn. And your journey begins as a martial artist. In multifamily, same thing, man. Once you get to that $1 billion level, that's when the journey begins. And that's when it gets fun. And then you can just start going,
Wow. That's a good way to put it. The other thing that you talked to right about this point is he talked about, I believe, Blackstone being a buyer versus a dentist. Again, we're going into an interesting market. Not a people can get loans. But I guess his point there is if Blackstone wants it, they could write a check, is essentially what he's talking about. Which I thought was interesting. You guys circle back to this later. I'll bring it up now. And I think you brought this up. Lots of people want to be value add multifamily investors, which means buy junk, fix junk, raise rents, raise value. But it sounded like he's tackling that differently, and he's being a value add portfolio. I think we need to scratch that a little bit, because that's A, I've never heard that before. But B, that's a unique exit, and then he's going to benefit from that. I believe. So let's talk about that.
Yeah, I've seen a couple of people, wonder how do you add value to a Class A? So understanding, at that level, it's called core plus. So there's core assets, which are stabilized, not really much upside. You can always enhance the income through another way. So multifamily properties are valued on income. So all you have to do is enhance the income, which isn't always through rentals, right? There's other ways to generate income, enhance income through reducing expenses, efficiencies, across multiple platforms, just a number of different ways. So in terms of at the level of the Class A properties, what happens is, as a retail buyer, which is what Grant is, versus a wholesale buyer, which is what a Blackstone would be, he can still take advantage of smaller deals. They're going to trade at higher cap rates and accumulate those assets. Think of it like a mutual fund, right? You're aggregating assets and then, pooling those assets. So the value that's created now, obviously he's going to increase the income so that the income is up there because it's still going to trade at a cap rate. But the value is more in terms of aggregating those assets so that you have scale over 10,000, 20,000 units, that you've increased the income $10 a unit. That makes a big difference in the value of that portfolio. So now you've got a buyer that can pay a 3.5, 4 cap on something like that, versus a 4 or 5 cap. So it's across the entire portfolio where that scale is created. Does that make sense?
Yeah. So maybe, again, I want to repeat what I think I heard to check it out. So again, Blackstone is always in the market, BlackRock, all these big hitters.
There's REITs, there's all kinds of people. Yeah.
They basically want to, like we just talked about earlier, right? They want to do one transaction and get size. That means there are individual assets that are just too small for them, right? Let's just say 100 units, right? 100 units, too small. Doesn't matter where it is, too small. But somebody could come in and buy 20 100-unit buildings, thus having 2,000 units. And in theory, that collection of 2,000 now hits the radar at Blackstone. So you buy them at 6 because they're not a competitor. You wrap them around and you sell them at 4.5 or 4 or whatever.
Right.
That's what all that means.
Exactly. And they have a vehicle that they've created, a fund that they've created that's looking for yield, which is a low spread on an investment. So their money is almost free. So they can come in and they can take advantage of these things, at a low cap rate because all they need is yield. So are the life companies. I mean, there's life companies that are buying assets direct, right? So they can do the same thing. I'll give you another way to understand this. Okay. It's kind of like the world of equity capital with companies. Okay. A dental office, let's just talk about a dental office because this is a thing where you can roll up dental practices. Okay. A dental office standalone by itself will trade at probably 3 to 5 times EBITDA, earnings before interest, taxes, depreciation, and depreciation. 3 to 4 times, maybe 5 times. If you put 12 of those together, it'll trade at 13 to 15 times EBITDA.
Okay.
You see what I'm saying? So the value add is in putting together and pooling the assets, because now a bigger equity fund can come in and buy that thing because you've got 12 or 13 and you've got a platform, so they can scale it versus one dental practice. Same thing in real estate. A single asset in general is only going to trade for X because you got a retail buyer audience. Right. But if you've got 100 of those, then you got a different level buyer who's looking for yield with certain quality assets that will pay a premium because you've put this together, all in the Southeast region, Class A, 200-300 units and up. You know what I mean? It's very specific.
Yeah. Basically you're saving time to our earlier conversation about 100-unit apartment versus 50 houses. You're saving time by building the portfolio. See, it's all making sense now. The next place you guys both went was he wish he bought more, bigger, and better. I get the more part. That makes total sense. I guess we need to talk about bigger and better. Why don't we talk about that?
Same thing we just said. So you have a higher end buyer pool for nicer assets when you go bigger and better. And that was a question because he said I should have bought lower cap rate properties and more of them. And people are like, what does that mean? So the lower the cap rate, the better the asset. And his money is so cheap, you don't usually on one deal when you've got 50 of them. Okay. It's kind of like a hedge fund, so that's another way to understand what I'm talking about. A hedge fund moves, a hedge fund moves hundreds of billions of dollars, right? Tens of billions to hundreds of billions. So all they need is a quarter point on that move and they're making money to a point. Okay. Same thing with multifamily. So if you've got a big gathering of these assets and they're all nice and they're all good quality, you don't need much spread because you've got it spread out over different assets. So you don't have to have as much room in that cap rate. The reason you need that room on a value add is because you're doing a big lift, right? So you've got to be able to come in and increase that, through the value add play because they're not as desirable of an asset at the end of the day. There's only going to be so many buyers for those things, and
Right.
it's going to be a retail buyer. So that's what he meant by that. And then they're easier to finance. So the nicer assets, the bigger they are, the nicer they are, the more institutional quality they are, the easier the money is to get, the more of a debt fund pool there is for those, the more of an exit there is for those. Better quality buyers always looking for those. Same reason Manhattan real estate trades exponentially, because it's their trophy assets. They're nicer assets, better quality tenant, newer, nicer, good areas, all that kind of stuff.
Yeah. Perfect. Thank you. And then the next thing you guys went into is just the realities of what are coming. Again, as a preferred buyer, as somebody in the business, banks are again going to take him or bring him deals to consider. And I don't think many people are appreciating, being a good operator is going to give you opportunities that you and I, well, not you, but collectively you and I never see, and they're going to be low cash down deals. They're going to be like, here's some debt, here's some incentives, maybe escrow some repair money, but help us out. Those are coming for guys like him.
Low and no, and for guys like you. So all you need to do is be known in that world. So you need to be talking to the banks, local commercial banks that have portfolios that they've lent on, and say, hey, this is Michael. Here's what I buy. Here's where I buy it. If you get any distressed assets or anybody needs help, call me. Attorneys, lenders, and realtors. Okay. So, and this happens to me all the time. And this is how I built my career over the years. And especially in 2009, I had a lot of banks who would call me up and say, hey, Greg, I've got a subdivision over here that, so-and-so bailed out of, you can't finish it. You want to come in and take it over? And I'd be like, yeah, sure. As long as you guys will fund the rest of the infrastructure. And, oh, by the way, you'll fund all the houses. And, oh, by the way, you'll let me pay you as it goes,
right,
as everything sells, or let me earn a profit as everything sells versus you get paid first. You need a cut of everything. Usually when you do a development, they want to get paid first before they release profit to you. So let's take that to Grant's level. So again, there's only a handful of people now that are going to be able to just walk into a transaction because they are approved. They do have the balance sheet. They've got the appetite. They've got the infrastructure to be able to walk into a 1,000-unit portfolio that's in default and be able to come shore that up, because it might take 4 or 5 or 6 months, to be able to get through that and to be able to understand the value of that. So that's absolutely what will happen. It's going to come from brokers, and it's going to come from the banks and attorneys, bankruptcy attorneys, and civil litigation attorneys that are going to be dealing with these issues. They're going to reach out to people that they know that are a known quantity that are buyers.
And this, again, just to try this all together, because again, I'm trying to catch up to 2 guys that are way ahead of me. This is why he wants to switch it up to a blind fund, if I remember the vocabulary correctly, because he's going to get opportunities that come in on, what is today, Wednesday, that come in on Thursday that he had no idea about on Tuesday, and he needs a quick yes or no answer, I'm guessing.
Yeah, potentially, yes. And then you got to be able to move like that one. They said, hey, if you can buy this thing sight unseen, ready to close, it's yours.
Right.
We're not even going to bid this thing out,
right.
So that's what happens. That's where you get true off-market direct-to-seller deals where there is no competition. You're just the right buyer.
Yep.
And I'll give everybody a way that they're going to be able to instantly understand what I'm talking about.
Okay.
This is Warren Buffett's business model.
Yeah.
What does Warren Buffett do in 2009? He sits and waits for the phone to ring.
Yeah.
Right. From big companies that need $100 billion. Same thing, different level.
Yeah. Awesome.
Same exact thing. And, there was an article the other day that's, Charlie Munger's like, our phone ain't ringing.
I saw that too.
Because we're not there yet.
Yeah, exactly. Wow. That's scary. That's so scary. We're not there yet. Oh,
it's not that bad. Okay. So there's a lot of unemployment. There's a lot of stuff going on out there. There's a lot of speculation, like Grant said, there's a lot of reports about the housing market, rental market, and all that. But you and I know most everything is pretty stable. It's a bunch of, speculation, and they're lumping everything in. They're lumping low-income housing, Section 8, everything.
Office and retail. And
office, retail. So when you see those numbers, that's what they're talking about. Now, what is real is that, I don't know what the numbers are going to look like tomorrow, probably another 5 million, so the effective unemployment rate is probably around 25% right now.
Yeah.
And it's going to take time for this economy to rebound. Even when we do start opening, it's going to take time, to get this thing going again and get it flowing. So, that's the reality of what's going on.
Yeah. Very cool. So the next thing I want to talk about, he spent a lot of time on this again. He is showing why he is different or at least why he feels he's different than other syndicators that are more Wall Street oriented, 3 to 5 years. He talked about 10 years as the hold period he likes. He talked about lenders liking 10 years. He talked about investors liking this 10 years. And really what I took from that is, it was mentioned in that is you're able to avoid a cycle, right? Which is basically, hey, this is what we're in now. It happened in 06, 08, whatever you want to say. If you're caught in a 3 or a 5 year, certainly if you're in a 3-year money or 3-year debt cycle, that could be painful. And I think that's what he's talking about.
That's part of it. Part of it is you can weather, the cycle because you're not trying to refinance right now. When, the credit markets have dried up, the loan requirements have changed, interest rates are higher. So if you're trying to refi right now, you got a little bit of a problem on your hands.
Right.
And that's where some of these opportunities could potentially lie in the future. And this is at residential all the way up the spectrum.
Yep.
So that's number one. Number two, what he's talking about is, at that level, lenders, it's like, you've heard of prepayment penalties and, loan defeasance and things like that. Lenders make their money by having the money out. Okay. And the longer term you get, the cheaper the interest rate is. Just like in a residential mortgage, 30 years is going to be cheaper than a 20 year is going to be cheaper than a 10 year. Commercial's the other way around. Right. So, those loan terms on big deals generally are shorter anyways. Most people are looking 3 to 5 year value add. So when you go out 10 years, the investors of those loans, the insurance funds, the life insurance companies, the pension funds, educational endowments, that's who's investing in a lot of those mortgages. They don't want to have to keep looking for the next investment to turn that money over. If they know, hey, I can buy this and my money's good for the next 10 years and I'm going to earn my yield, they like that. And again, that goes back to the nicer assets, because that's only going to be, they got to be backed by nice assets in good areas. So everybody's comfortable. So you can get cheaper loans, you can get better rates, and it's an easier loan to get done.
Got it. And so my final question, again, if you don't know the answer, totally okay. But it sort of seemed like to me that Grant's ultimate vision, he's going to get to some number, 20, 30, 50,000, whatever it is, some big number. I think he's 62 today. I think I heard that recently. So maybe it's by the time he's 65 or 68 or 70. His vision of all of this is he is going to exit to a Blackstone-like company, single transaction, get a big payday, right off into the sunset. Is that kind of the exit he's playing for? And again, if you don't know, totally fine. But that's what it felt like.
That's what he's saying. That's what he's saying right now. He's saying that, right now, and you got to have multiple exit strategies, right? So when you have a business or an investment, you want to have multiple exit strategies. So right now he's saying I could put all these together and exit to a REIT. He just says Blackstone because, they're a player and they're out there, but there's 100 companies just like that, that are very strong, that are, and there's some in trouble, in the retail office hospitality sector, that may not be here, next week. But so that's one strategy, is to exit to those guys. But then you have a problem. Okay. So when you do that, then what do you do with the cash? Because he still has family and all that, and he still has to be, a prudent fiduciary of that cash. So if you exit something like that, you still have this cash issue. Yeah. So then what do you do? So, so that's one strategy. The other is just refing onto it, and leave it out there that never sell anything. So, who knows? Right now, that's what he's saying. 10 years from now, who knows?
Yeah, who knows? Yeah.
You change as you get older, and as your kids grow up.
As you mature, you get older.
Yeah,
that's true.
And I've been a seller, right? So I've turned my entire career: buy and sell, build, sell, buy, sell, build, sell. I didn't hold long term, and a lot of people ask me, would you have held on to everything? Looking back now, and 2009 was not a good time to be holding.
That's true. Yeah.
So it just all depends. I mean, everything moves in cycles, but multifamily has performed over the years. I don't care what anybody says. Housing and multifamily has not gone away. People still need somewhere to live. People still, need a roof over their heads. They always will. That is not going to change. The only thing that changes are the values and the financing.
Got it. So I know you've gotten a lot of questions. Maybe some of them we've sort of touched on, but maybe we didn't hit in detail. Any questions you got that you just want to add to the end of this discussion?
I think that was it. People were asking me, how much did you pay? And like, I didn't pay to be on an interview with Grant. Yeah. We had connected last year, through some emails, and I'd talked to Ryan. Grant and I'd never met, on some different topics. So he knew who I was, when all of this stuff started going down and everybody, just saying all these things, I reached out to Grant personally and said, look, let's do an interview and, clear the air and talk about the business of multifamily in a way that people can see. Number one, what you're doing, you're an operator and this is a business, and, let's just talk about the numbers of it and just put all this stuff to bed so people could see what's really going on. Yeah. And I think it was good. I think he enjoyed it. I enjoyed it. I think, the comments I've seen, people loved it. They said it was just phenomenal. This is great. It's a real in-depth inside look at something that's very high level that a lot of people, and that's why I brought it home at the end. A lot of people are like, oh man, 7,700 units, 1.7 billion. I'll never get there. He started with nothing 30 years ago. So you can get there. The question is, do you want to? So do you want to have 100 houses or 200 houses, which is great, over a 20, 30-year period? Absolutely nothing wrong with that. You can build tremendous wealth that way. Yeah. Very, very good way to do it. Or do you want to do that and grow and scale? If you do, you can. There's nothing stopping you. Start with a house, then go into a multi-unit, then go into bigger and more. And, and it's just a compound effect. Yeah. Once you've done one, you can do 10.
Yeah. Again, I love the interview. You didn't hide from anything. You talked about holding back distributions. You guys nailed that. Didn't have to ask any questions. That made total sense. It was a good business decision. You got to protect the equity, protect the building, all that. He doesn't want to give anything. I think you guys nailed that really well. Yeah, dude, I thought it was great.
Broke up the splits.
Yeah.
We broke up the splits on the profit, which again, there's a preferred return the investor gets before anybody gets paid. And by the way, those distributions that are deferred, they do get caught up, at the end of that suspension. It's just deferred, so it's going to get caught up. He doesn't get paid anything till his investors get paid first.
Absolutely.
And then whatever profits left over after the investor's been paid, then they share that, and his split is 65-35. It's a very traditional common split. Some are 60-40, some are 70-30, some are 65-35. Mine, whenever I've allowed people into deals, have always been 50-50, with no pref. So my deals on the development side, if you want to come in and bring all the money, I'll let you in, but you're going to bring all the money and we're going to split the profits. Or I'll just give you a preferred return and you don't get any upside. So, there's a lot of ways to structure deals and do deals. There is no one right way. There is no what's fair, what's not fair. In the world of stocks, in the world of like Blackstone's investors, all they're getting is a return. They're not getting equity.
Dividend.
A lot of times. So, so there's a number of ways to do it. What I would say is the bigger the return somebody's offering you, beware, because there's only so much you can do right now with the way debt is and the way these deals are. And the bigger the split, there's a reason for that. If somebody's giving you a 90-10 or an 80-20 or something like that, it's because they have to make that deal work.
Right.
And it's a lot of work, so the other thing is the asset management fee. Like a lot of people beat him up over that 1% asset management fee. Go to the website. He's got a team of 20 people. That's barely covering the overhead to run the operation. It takes money to run the operation. Everybody in the industry charges an asset management fee to manage the asset on behalf of the investors. You need to. You got to spend money to professionally manage a portfolio and manage those managers. Even though you have professional property managers, somebody still has to be over them, directing them, checking them, the financial reporting that's required, the investor management system alone is a couple $100,000 a year. So that 1% management fee that he gets on the capital, if you take a $300 million fund, which is about what he's got out there, 300-400 million, that's $30 million. That's not a lot of money, to manage a portfolio like that.
Yeah, they're working harder today than they've ever worked. Would be my answer to that. It's certainly money well spent today.
It is, and it's real work.
Yeah.
Whether you're managing 1, 10, 100 houses, or you're managing 1, 10, or 100 apartment complexes, it takes real work. And what a lot of people, so I teach people how to raise capital. Mm-hmm. And I've done videos on it. And I know, you probably have, you did a video on raising private capital and your split and how you do things. When you are raising capital and you're bringing investors in, what are you doing? You're giving them an opportunity to put their money to work. You're doing something for them. You're giving them an opportunity to invest and put their money at work. Mm-hmm. And there's not a lot of opportunities out there for people that only have $5,000 or $10,000 or $20,000. So the fact that he's willing to do that, I'm not going to do that.
No,
You're not going to do that.
No chance.
You know what I mean?
No
You did a
chance.
video on that non-accredited,
Yeah.
I mean, I don't deal with anybody who's not liquid,
Yeah. Again, I'll put it out there right now. I think there's a pretty good chance on the other side of this event that non-accredited investors get cut out of potentially investing because there's more of them. It's greater cost. There's more risk. There's more headaches. I've done interviews with non-accredited investors, and they think differently, rightly or wrongly. It's just a fact, right? I've had 10 conversations, about 5 and 5, and you could just tell they just think and
Yeah.
operate differently. So pretty
Yeah. And it's,
interesting.
and part of it is they're not reading,
Yeah.
understanding, and you're not getting professional advice, and again,
Yeah, they don't have the advice from a attorney or a portfolio manager or that second set or third set of eyes, right? That's the piece they're missing.
yeah. And if you're going to invest, do that. Get an
Yeah.
attorney, spend $500 to $1,000, to get an attorney and an advisor to review the documents in the deal. Excuse me, it's a little pollen in the air getting stirred up by the wind here today. So, make sure that you get that advice and have them review those documents so that you do thoroughly understand, what you're getting into. And when you've been, had disclosures multiple times and you have to click on the button saying, I understand, number one, I can lose all my money. And I have reviewed this and run this by my advisors. And when you have to click and say you've done that, don't complain.
Right.
Don't.
Yeah.
Because you clicked and said, I sought the advice of my legal counsel and my investment advisors. And, I mean, you just can't complain. It's like building a house on the golf course and fussing when you get hit with a golf ball.
Well, they can complain. They will complain. That's the American. That's just who we
That's always
are.
been my analogy. So as a developer, I've been, the evil developer my whole career. So as a developer, you take a lot of hits. You take a lot of heat, because people never want it in their own backyard.
Yeah.
And that was always my analogy. If you don't want to get hit by a golf ball, don't buy a house on the golf course.
Yeah, exactly. Yeah. Don't buy it about the middle of the driving, the distance. Right turn. Well, great. This has been so much fun.
Next to the tee box, all you hear there.
Yeah, exactly. Be by the tee box. Yeah, exactly. This is a lot of fun. I really enjoyed that interview. I'm going to link first line in the description. It's going to be the link to your page. If you haven't watched Grant and Greg's one-on-one interview, I highly recommend it. I've seen it twice and may watch it again. Thank you for answering all these questions. It really helps translate what I heard and help me piece together my understanding of my little world with what the big boys do. I appreciate it.
Yeah, maybe round 2 we'll do business and entrepreneurship. I think that'd be a good one for a round 2 interview.
You got it. Thanks, buddy.